Thank you. Esteemed clients, a very warm welcome for today's exclusive session hosted by Kotak Neo. We are delighted to have you join us for an enriching conversation, one that goes beyond market noise and gets to the heart of what truly matters, which is building lasting and meaningful wealth for you and your families. We have curated this session with one purpose: to bring to you the best perspective, straight from one of the most celebrated minds in asset management in India. It is my honor to introduce a name that needs no introduction in the Indian mutual fund industry, Mr. Nilesh Shah, Group President and MD, Kotak Mahindra AMC, with an experience spanning more than 25 years across various asset classes, including equity, fixed income, and real estate for both domestic as well as global investors. Nilesh Bhai obviously has been a defining voice in shaping how India saves and invests. He's a gold medalist chartered accountant and a merit ranked cost accountant and has led his teams to win various prestigious awards, including Best Fund Houses of the Year multiple times with reputed asset management companies like Franklin Templeton, ICICI Prudential, and Kotak Mutual Fund. Nilesh Bhai is also a part-time member of the Economic Advisory Council to the Prime Minister. Before we go to Nilesh Bhai, if I could request Mr. Manish Kathuria, Chief Business Officer, Kotak Neo, to share his opening remarks and perspective. Manish, over to you, please.
Thank you, Siddharth. Welcome and a very good afternoon to all our esteemed clients. Thank you, Nilesh Bhai. What could be one of the most timely conversations we could be having today, because as we speak, the US-Iran ceasefire expires, I think, tomorrow, and the whole world is watching on the sideline talks at Islamabad. What began on 28 February as Operation Epic Fury by US and Israel over the past 52 days uh, is not only impacted the warring parties but the entire world. It's reshaping the global energy markets, rattling the currencies across the globe. The Strait of Hormuz, I believe now, is a most well-known strait. I think probably every household would today, in right or wrong ways, be knowing the Strait of Hormuz, through which one-fifth of the entire world oil is flowing around, and India in particular is kind of impacted big time. So, with oil at swinging between 95 to $100 and running up to even 115, 120, rupee touching 95 before recovering, Nifty falling more than 10% in March. FI is pulling out almost a lakh and 60,000 crore since March. But yes, Indian investors are still showing their faith in the markets, and most of the mutual funds we saw in the month of March, and that's continuing in the month of April, are putting most of the Indian investors are still putting money in the markets. Uh, so I think it means a lot to the Indian investor and the Indian economy. We had other wars, name an example of Russia, Ukraine going on, but it didn't have so much of impact on the markets the way the current war is having. So of course we are delighted to have Nilesh Bhai, who's one of the most respected voices, and we look forward to an engaging conversation with Nilesh Bhai. Thank you, and over to you, Nilesh Bhai.
Thank you, Manish Bhai. And I'll just take a second to share our presentation. As many a times, a chart says more than 1,000 words. I hope you are able to see the presentation. Essentially, as Manish Bhai described, this market is neither a bull market nor a bear market, but a kangaroo market. It's going up and down based on how events are shaping up in Middle East. If you look at global economy, 3 Bollywood movies describe current situation quite well. First, डॉन को समझना मुश्किल ही नहीं नामुमकिन है. That has continued to impact every investor. If we see current US empire. It resembles to what happened to Roman Empire on its decline. Wars, debt, spending. We have seen this movie before. Normally, such cartoons were made for emerging market Banana Republic. Now, this is being made for United States of America. Hormuz Strait was carrying 20% of global crude and gas supply. This data was taken 2 days back. Number of ships moving were about 18% of normal, but the cargo throughput was just 9% of normal. Essentially, world was running short of roughly about 18% of oil and gas. There are alternatives to Hormuz Strait. This is the Strait of Hormuz between Oman and Iran. Saudi has a pipeline which takes oil from Persian Gulf to Red Sea. UAE also has a pipeline which bypasses Strait of Hormuz and goes into Gulf of Oman. Unfortunately, both of this have combined capacity of just about 8 million barrel. The Yanbu route operates at almost 100% utilization, and Fujairah pipeline is operating at about 71% utilization. Collectively, they have taken the load of about 7 million barrel additional, and yet 18 million barrel minus 7, 10 to 11 million barrel remains in short supply. Oil is the base material for many chemicals, petrochemicals products, and they remain critical for many base industry. While it is difficult to predict Trump, we believe potential scenario could be something like this. A stalemate is victory for everyone. US, Israel will get Hormuz open. That will lower oil prices, and they will claim there is threat reduction from Iran with their nuclear and ballistic missiles taken out. Iran gets continuity of regime. They may even charge toll on passage through Hormuz. Iran also becomes more radical, less competent as their top leadership has disappeared, and it will become more ruthless to internal dissent. Implication for rest of the world: become Atmanirbhar in energy and also defense. The world today is also witnessing trailer of what happened during subprime when fixed income market froze. Many private credit funds are stopping redemption, and there are some people who are comparing this vis-a-vis 2007 subprime warning. We all know what happened to Indian market when subprime risk came and hit our shore. At this point of time, market believes private credit is unlikely to be as disastrous as subprime, but keep a watch what happens over there. The second thing to watch out for is crypto. It has massively corrected. This has also destroyed wealth for crypto holders. Finally, apart from Middle East, there is another geographical risk, which is Taiwan. Today, US imports more from Taiwan than from China. That being the case, could there be move by China on Taiwan. While Middle East provided 20% of global oil and gas, Taiwan provides multiple times that in semiconductor chips. Their blockade or invasion could have material adverse impact across industries from automobile to electronics to even hospital and tourism. What's the silver lining among all the dark clouds? Well, crude market believes this war is temporary, supply will normalize, and crude prices will go somewhere towards 80 handle in the second half of current year. Let's hope and pray markets are right. Otherwise, there will be significant consequences. In the Indian context, do remember whatever one says, opposite is also true. In Bandra Kurla complex, you have opulence of Geo Center where world's most expensive wedding took place. And on the outskirts of BKC, Asia's largest slum, Dharavi also stays. Both contradictions coexist in India. Right now, we are in Chakravyu as rising oil prices is like a Rahu Kal in our Kundali. Oil goes up about $10, CAD widens by 36 basis points, puts pressure on rupee. Inflation goes up by 35 to 40 basis points, puts pressure on interest rates. Growth comes down by 20 to 25 basis points, puts pressure on equity market. Markets were vulnerable on interest rate cut cycle was about to end. Now there is a need to increase because of the rising inflationary pressure. RBI was short forward $70 billion. With this rising current account deficit, rupee weakened further and RBI has limited tools to defend. Corporate profit was hit because of rupee depreciation, because of labor code implementation. Now rising energy prices and supply chain disruption is reducing profit to almost zero in fourth quarter in terms of growth. FPIs were selling Nifty 50 as India was most vulnerable to oil price increase. They accelerated their selling in the month of March. GDP, because of base effect, was coming down in terms of growth. Now there is a hit of 0.5% to 1%. Net, India's economy was vulnerable with lower immunity, and this rising oil prices could not have come at more inopportune time. What is our interest in Middle East? 90 lakh Indians work there. They should be safe. They send $50 billion by way of remittance. That should continue. We have reduced oil intensity of our GDP, but we still remain vulnerable in terms of availability of oil. What's government doing right now? They are following Sam Dam Dand Bhed policy to buy energy. We are buying from Russia, Venezuela, Iran, Africa. Essentially, wherever cargo is available, whatever price it is available, we are procuring. Apart from this crisis, where does Indian economy stand? I think we have a role model in China. For many years, China pursued real estate development at a scale where they were consuming cement used for construction of Rome all throughout history in just a single day. There is a proverb which says Rome wasn't built in a day, but Chinese cement consumption on a daily basis was good enough to build one Rome. Once they realize they have built more real estate than necessary, roads which people are not using, real estate which people are not able to occupy, they pivoted from real estate to industrial sector, poured money in building manufacturing capacity, and in no time became world's largest automobile exporter, overtaking Germany, Japan, South Korea, and US. We need to create that kind of dominance, that kind of focus. China is not resting on its laurels. It's building nuclear reactor for energy independence, and they are building more nuclear reactors than rest of the world put together. Few months ago, I had visited Japan. I went to Suzuki headquarters. This was model of their first vehicle, Suzu Light. It reminded me of Ambassador. There was a time when India set up Asia's first auto factory in West Bengal, making Old Morris known as Ambassador in India. Even Japanese auto manufacturers came to India to see and started copying there. Where have they reached and where did we remain? We did well, but others did far better than us. Apart from Middle East and current situation, the real challenge for us is artificial intelligence. About 4 crore Indians work directly or indirectly in BPO, KPO, GCC and IT industry. Collectively, they earn $350 billion revenue that allows us to buy oil, buy gold, send our kids abroad for education. If artificial intelligence impact jobs in IT industry, it will have disastrous consequences not only for IT, but also for rest of the economy. How do we see AI developing from here onwards? Well, we'll need companies which can make apps using LLMs for reaching out to consumer. Today, in voice AI, Luna and Maya 1 are closest to human voice with emotive capability. If more such apps are created in India, AI will create more jobs and revenue in India as people start using these apps for their day-to-day activity. India also launched its own sovereign AI platform, Sarvam. Many of the LLMs have backdoors and people are worried about data secrecy. If we can position this as a platform where people don't have to worry about data secrecy and backdoor, then this can become preferred vehicle despite not having as much capacity. Finally, our growth rate will be dependent upon how we invest for the future. Recently, when China banned rare earth exports, there were a couple of startups in India which were making rare earth free EV motor. If we can commercialize this and make it on scale, suddenly China's trump card of rare earth disappears. RDI fund and Anusandhan National Research Foundation is putting money in research. RDI fund itself will be about 1 lakh crore over a period of time. Hopefully, India will be able to create innovation which will sustain its growth. How do we convert this economy into market? Undoubtedly, economy has challenges in the short term, but the long-term growth story remains intact. If we see last 1 year, Small cap corrected significantly. Large and mid cap, by and large, corrected little less. Sectorally, metal, IT, and healthcare outperformed in a falling market, but real estate, banking, auto, FMCG, logistics underperformed the fall. This fall was caused by FPI selling. They sold about $19 billion in CY25, and they have already sold $14 billion year to date. Their selling is driven by the fact that rest of the world is delivering far better return, like Taiwan, Brazil, Mexico, Korea, whereas Indian market delivered negative return. Courtesy the drop in the market, our premium valuation to other emerging markets have come down by 1/6. From trading at almost 100% premium, we are now at about 27%. This is lowest in last many years except 2017. Our share in global GDP, global market cap was about 4.6% at peak. Today it is down to 3%, near our historical average of 2.8%. Valuations are now fair. Large caps are trading little below historical valuation. Mid caps are trading little premium, and small caps are trading little higher. But compared to the past, small, mid, and large are nearing their historical valuation. This year, earnings growth for the market for FY26 will be impacted by rupee depreciation, labor code, and Middle Eastern conflict. But if oil prices settle around $80, then we could see double-digit earnings growth in FY27 as well as FY28. This will be mainly the momentum build on GST rate cuts, income tax cuts, and the reforms initiated by the government. One conclusion of the past: war does end before, the market bottoms out before the war ends. It happened during Kargil. It happened during Russia-Ukraine war. Probably similar things will happen going forward also. Will FPI turn buyers in the market? Well, for FPIs to turn buyers in the market, we require two things. One, investors should take money out of US. Normally that happens when US dollar depreciates. This time, despite US dollar depreciation, investors have not taken money out of America. Will that change in 2027? We have to see. So for FPI to turn buyer in India, money has to move out of America. And second, and more importantly, it should not go to China. Chinese markets have done extremely well in last 3 years, but it is trading where it was 17 years before. Chinese markets have gone up and down 5 times in last 5 years. 6th time also they go down instead of going up. Then money coming out of America will come to India rather than going to China. For that probability to happen, there has to be anti-AI trade. AI undoubtedly is impacting world, but will it be profitable? Not everyone knows. What do we recommend investors? Last 6 years return was about 12% in the broad market, driven by mid and small cap at about 16 and 19%. 15 years before, broad market was about 11%, driven by mainly large and mid cap. On a 20-year basis, large, mid, small are almost delivering similar return, and the broad market delivered return of about 3 to 4% over inflation. If you are looking to get this kind of return, it may not be possible in 1 year. If you are looking low double digit, high single digit kind of return, that should be a reasonable assumption. So everyone will have to moderate their return expectations. That is the most important conclusion from here. With this, I'll end my talk, but happy to take your questions.
Thank you, Nilesh bhai. While we collate questions from the audience, few questions basis the presentation, as usual, very nicely summarized on not only the war, but the big event, but also you nicely summarized around the impact on the Indian investor, the Indian markets, and taking some cues from there. My first question is, we saw this big event unfolding in the month of March, and markets were double-digit negative returns. Of course, reasonable bounce back in the month of April. Two very diverse trends. FIs taking off money from the markets, but on the other side, the domestic mutual funds. My understanding is March, the net sales on the equity was very, very high, and the trend continues in the month of April also. So while you have shared a lot of data in your slides, my question to you is, while Indian, why so much of divergence? And of course, there's a talk that the Indian markets, despite you showed in your chart that the valuations vis-a-vis the other markets is gone to an all-time low of 27% gap. But is there a merit for an investor to probably look at some exposure to the global markets from here? First, the trend
Undoubted.
divergence between FIs and the Indian mutual funds, and second, the impact on the investment for, let's say, an Indian investor today. So, two questions here.
So thank you, Manish bhai, for asking this question. I think it is important for every investors to diversify in their portfolio outside of India. The first need is because of geographical diversification. हमारे 3 नेबर है, इंडिया, चाइना, पाकिस्तान, बांग्लादेश. If something goes wrong, whatever you have invested abroad will be safe. Second, there is a need for business diversification. Today, if you want to invest in biotech, if you want to invest in deep tech, semiconductor chips, robotics, not many businesses are available in India. Going abroad will give you business diversification. The third is the currency play or a valuation pay. Few years ago, we were trading at 2 sigma above our historical average premium to other markets. Today, we are trading 1 sigma below. So you will have valuation play. So every investor should diversify using LRS schemes for investment abroad, geographical, business, as well as valuation. Now, as a mutual fund, when I am getting money, my mandate is to invest in equity market. And we fulfill that mandate by investing in stocks which we believe will outperform the market. If market goes down 20% and I fall 10%, I feel very good. I have outperformed market by 10%. My investors may not feel so. But we are relative return provider, not absolute return provider. So do diversify overseas, and do remember that mutual funds are relative return chasers, not absolute return generators.
So you are saying there is a merit in geographical diversification to global markets. Great. Nilesh, my second question on the big event. Of course, we have seen Donald Trump's diplomacy of giving stark ultimatums ahead of the peace talks, and we don't know what's going to happen with the ceasefire kind of closing tomorrow and the talks in Islamabad. So, if I would like, if you have a view around this event, one view around that. My second question related is the oil economy. Now, with dollar hitting $100 and oil hitting $100 a barrel, even if let's say we heard good news on the war front and the warring parties kind of stop in the near future, the Strait of Hormuz is a new dimension which was not affected in the earlier one. So do you think the oil will get down to a 60-70 dollar which it was before the war, or India, in your, I think in your presentation you said we got to kind of live with an $80 and the impact on the earnings and the Indian economy. So two questions. One, if you want to kind of predict on what is going to happen on the big event, and the second question on the oil economy for India.
So we have no idea what will happen tomorrow. There are on the Bloomberg Terminal 3 headlines. One saying Iranian delegation is not going to Pakistan. Second saying that no, Iranian delegation is going to Pakistan. And third saying that no, they haven't yet arrived in Pakistan. So it's so difficult to guess what these negotiations are up to. But my feeling is that eventually this will be a stalemate. Regime will stay. They will charge toll on Hormuz. US, Israel will declare victory by saying that, look, Hormuz is now open and we have taken away nuclear ballistic capabilities of Iran. Everyone will be happy after a brief war. In that scenario, restoration of oil and gas infrastructure in Middle East will take some time. Qatar did mention 17% of their gas output being impacted. Kuwait also put force majeure. We don't know the real details of losses in the Middle East, as unlike India where there is freedom of speech and freedom of recording, in Middle East all those things are not easily available. So our base case remains in the wisdom of market. Oil will come down in second half of current year, but to 80 handle, not back to 60 handle. Now, in what scenario oil can go to 60-50? For that to happen, there should be cooperation between US and Iran, and US should invest in Iran to pump its oil. Iran is sitting on an ocean of oil. Their plants, wells under sanction are performing well below capability. If US can pump oil from Venezuela and Iran over next couple of years, other countries will realize that we need to front run them. Before Iranian crude had hit market, Saudi and Qatar and Kuwait will pump more oil. In that kind of scenario, oil can go towards $40-60. But our base case today remains 80 handle, not 60 handle.
And what is the kind of base case scenario you're building in terms of the event can go? I mean, what could be a worse situation, let's say, for our economy if the war was to prolong? So, how do you look at it in your worst case projection?
So the worst case scenario will depend upon what is the worst in the Middle East. God forbid if Donald Trump does adhere to his warning of destroying every power plant and bridge in Iran, and Iran retaliates back by hitting desalination plant, by hitting oil and gas infrastructure, by shutting down Red Sea, then we are in a serious trouble. Not only price of oil will shoot up, but availability of oil will become a huge challenge. Put together, our economy will get a hit just like COVID 2020. So if things deteriorate, the worst is likely to be far worse than what we are able to predict right now.
Got it. Last question before I hand over to Siddharth. Nilesh bhai, what we are seeing is, I mean, a lot of, India has a very strong partnership with the Middle East. You were mentioning in your presentation, it's not only about oil. You have 5 million Indians staying in UAE, Saudi, more than that, and sending a lot of remittance. Also, we've seen on the other side clear friction and fissures in the NATO relationship between US and the European allies. So, how do you see a future world scenario and its impact on the alignments in the world order, and of course the impact on the economies around?
So Manish bhai, this is more of a hope rather than what I expect. Purely from an Indian point of view, the world will get divided from a rule-based order to jiski lathi uski bhains. That should create blocks of countries. For example, US definitely will be one leader, China another leader. But after that, number three is far behind. Could Germany take the lead? Answer is unlikely. Could Japan take the lead? Answer is unlikely. Could India take the lead? Maybe few years down the line, but not today. Which means we will see emergence of 3, 4, 5, 6, 7, 8, 9, 10 coming together to create an alternate block which can take fight with number one or number two. If that happens, then India obviously stands beneficial. The European capital, technology, Indian labor put together can create wonder. If you remember, Manish bhai, in COVID time, AstraZeneca gave the IPR for COVID vaccine and Serum Institute manufactured it. It saved more than half of the world's eligible humanity. We not only gave vaccine to 140 crore Indians, but we also provided vaccines to the outside world in 50 plus countries. Neither US could afford it, nor China dreamt about it. Only Indo-Europe came together to do it. I just hope and pray that becomes the template. The Japanese and European capital, the Australian and African resources, and the Indian leadership and labor force put together, we create a third block, which then can manage jiski lathi uski bhains reasonably well.
Yes, that's apt. We think we are going to be seeing a new world order, but first of all, hopefully the event kind of gets behind us and there is peace in the world, because this is definitely an event which has impacted a lot of economies, particularly ours. Yeah, Siddharth, over to you.
Yeah, thank you, Manish. Nilesh bhai, some interesting questions in the chat. If we could just sort of get your responses on the same. The first question is that, with inflation cooling off structurally, India's nominal GDP growth has been impacted. Do you see that as a challenge for the, premium Ps that we were commanding, the Indian equity markets were commanding going forward?
Undoubtedly, yes. As our nominal GDP growth came down, the ability of corporate to generate profit also came down. The profit growth from 15-20% came down to single digit.
Correct.
That was going to impact our valuation at some point of time. It happened in 2025 as well as happening in 2026. So your point is absolutely valid, which is where some amount of inflation is positive. Of course, higher inflation is bad, but moderate inflation will help us. Using SIP for an ordinary investor doesn't work. When they stop when there are negative return, and then they forgot to start. In 2020, people who stopped their SIP saved money in the short term, but lost a lot of money in the long term.
Absolutely.
People who bore the pain and continued SIP did very well eventually. So my recommendation, don't pause SIP. Whenever there is negative return, do try to do SIP top up, buy more when things are cheaper. SIP is not just equity fund. SIP is also possible in precious metal fund like gold and silver. SIP is also possible in multi-asset allocation fund where fund manager provides private banking service to investor by allocating between debt, equity and precious metal. SIP is also possible in hybrid funds where risk return profile varies. So do expand your coverage of SIP from pure equity to hybrid to multi-asset allocation and to precious metal and also global equity fund. But continue your SIP for sure.
Another interesting question, Nilesh bhai, which is in the chat, is that if you had 1 crore rupees to deploy and with a horizon of next 5 to 7 years, how would you allocate it across various asset classes and themes?
So my recommendation, Siddharth bhai, don't go by what fund manager says. Go by what he actually does. Every month on our website, we put asset allocation of Kotak multi-asset allocation fund. As you will see today and every month thereafter, our equity allocation at this point of time is about 70%. That's higher end of neutral allocation. We are more biased towards large and mid cap. We are more biased towards banking and financial services, auto component and automobiles, hospitals and healthcare. We have invested about, and I could be a little wrong in number because I'm talking from memory, but about 16% in gold and silver, more bullish on gold than on silver at this point of time. And rest of 14-15% is invested in fixed income at the shorter end of the curve, up to 3.5 years. So this is my multi-asset fund allocation. You can monitor this on a monthly basis. That will determine what you should be doing in your portfolio.
Absolutely. Another relevant question is that in this volatile world, do you believe investors need to move from product investing regime to a portfolio thinking concept? And how is Kotak Neo enabling that shift? So, on the Kotak Neo question, probably Manish can sort of add some
Yeah.
points. But if we could have your perspective on product investing versus investing with a portfolio framework in mind.
So Siddharth bhai, I have always believed if your relationship manager is only selling a product, he's doing a disservice to you. He has to provide a solution. He is not in transaction banking. He is in relationship building. And how does relationship get built? By ensuring that your portfolio does well and you beat inflation and generate real return rather than one component doing well in the portfolio. So it is always about portfolio, never about product. It is always about relationship, never about transaction. But Manish by Kotak Neo.
Yeah. Yeah, thank you. I think the golden rule continues to be the asset allocation, and Kotak Neo today as a platform uh, enables the investor to kind of invest and do transactions basis the handholding given by our relationship managers across various asset classes. So mutual fund as an asset class is, I think, all encompassing. We do kind of recommendation through our advisors on what mutual funds to buy in the large cap space and the mid cap space. So there's a lot of equity schemes which are there. We are very happy to share that we have a lot of curated baskets which investors can check out under the stock case. So, for example, we have come up with a unique combination of gold and silver ETF baskets. Now, these are very, very interesting propositions, which are in a way a little unique also. So I think today Kotak Neo as a platform, apart from direct equity, is helping the transactions on the mutual fund front, ETF as an asset class is very popular. The baskets today is something which a lot of investors are taking interest in. So while we believe it's a beautiful do-it-yourself platform, our relationship teams would be more than happy to help you and assist you in terms of navigating the entire platform so that you can get the most leverage out of it. Nilesh bhai, a little sorry. So that was my answer. Nilesh bhai, I think today no conversation can be complete for an investor without a view on the commodities led by, of course, gold and silver. And we all have seen what we saw the last 8 to 12 months, and then what happened in February in the silver prices and gold prices also crashing up. How do you see as an asset class, and what about the old correlations where in a geopolitical situation like this, you would have expected, gold to have done better. But considering the kind of run up we have seen on the gold, so what's your view on gold and silver from here?
So Manish bhai, on gold, it is official front. The gold prices started moving up as cost of mining incremental gold was higher than the sale price. The gold prices got a shot in the arm in 2022 when Russia invaded Ukraine and realized that their assets kept in dollar, yen, euro abroad was seized and it disappeared from them. With that experience, every central banker started diversifying into gold. India, China, Japan, Poland, Russia, all these central bankers were buying gold to diversify their asset. It took gold all the way up to $5,500. In between ETF वाले भी join हो गए, front runner भी join हो गए. In last 2 months, Turkey, Russia, and Poland, this central banker sold gold. China, Japan, India didn't buy gold. Gold prices corrected. Now it has recovered a bit, little. So stay overweight gold as a part of your portfolio. Whether it is 5% or 15%, you take a call based on your risk appetite. But every month, observe what central bankers are doing. If they are buying gold, you buy gold. If they sell gold, you also sell gold. We are doing official front running of central banks by investing in gold.
But how do you see the central banks kind of in their behavior going forward, considering that there's a talk, I mean, that Iran has almost 25-30 billion dollars which is seized in the dollars, and I mean, that's the kind of impression and the discomfort which the central banks would have on the dollars. So how do you see, uh, could it kind of lead to further this thing, or the run up has been so strong that probably it's going to be stable or lose some steam from here?
So my feeling is that central bankers are unlikely to buy gold at any prices now. It has already moved from almost $1,200 to $4,800, 4 times up in dollar terms in 6 years. Their buying will continue, but with a price limit, and which is why gold will do well, but nothing compared to last year. Will it
Great.
outperform fixed income market in the medium term? My bet is yes, as long as central banks continue to buy.
Great. One more related, and of course, again, a very, very contemporary topic. Maybe the thunder got stolen by the war. Was the impact of AI, particularly on the regular software industry, particularly in context of the Indian IT industry? I think you had again one slide on this. How do you see it? I mean, of course, we've seen the IT giants having a kind of not a great run over the last 12 months in terms of the stock prices. So, what's your view around the impact of AI on the general software, particularly in context of the Indian IT and the fact that it contributes huge to the dollar reserves?
So it is either opportunity of lifetime or risk of a lifetime. And today we don't know which one is true. When I go to IT company and say, look, AI is transforming the world, they say, Nilesh bhai, we do transformation every 5 years. We started with Y2K, making 00 to 2000. Then we migrated to infrastructure management, started managing in-house servers and computers and LAN network. Then we moved into software writing. Then we moved into programming and consulting. Then we moved into cloud and cyber security. Now we'll move into AI. हमारे लिए कोई नई बात नहीं है. When I go to strategists to advise on AI, they said you have no idea. There will be no job called software developer because AI will write codes. Go back to IT company saying that there's no need for your employees, software developer. AI will write the code. They say, look, anyway, we were maintaining library of our codes which we had written. And we were doing cut, paste, copy jobs, albeit with human intelligence in developing programming. AI is also doing similar thing, albeit with some more fineness. Second, the job of programmer is just 20% software writing. 80% is meeting customer, understanding their requirement, right, creating workflow, designing workflow, writing programs, executing those programs, implementing them, securing the data, strategizing the output. Put together, 20% is program writing, 80% is something else. You go back to AI strategists saying that, look, this is only 20% impact, 80% will still remain. And he said, Nilesh bhai, you don't understand now, plugins have come. Forget about AI and IT services. Think about fund managers. We will be able to replicate you. There will be AI avatar of Nilesh Shah, which will understand Nilesh better than Nilesh Shah himself, and he will build portfolio. So we'll be able to outperform you. आप अपने job की सोचो. We go back to IT industry saying that ये plugins आ रहे हैं. And they said, look, you see how many enterprises have actually benefited from AI. Have they made return on investment? Are they not worried about their data? We haven't seen any order getting cancelled because of AI. We don't know, Manish bhai, where the truth is. Either it is opportunity of lifetime with enterprise AI, apps for LLM, and Servam itself becoming a base, or it is a risk of a lifetime where 30, 40, 50 lakh people will lose job and we will need to find alternate employment for them. Until such time they find new jobs, there will be impact on banks because they have lent money. There will be impact on real estate industry because these people were buying real estate. There will be impact everywhere. But we don't know where the truth is today, hand on heart.
So Nilesh bhai would be a buyer at for the IT stocks at these levels, or what will be
So,
your kind of view on that?
very good question, Manish bhai. And like we predicted, stalemate will be considered victory by both sides. On AI and IT, our view is that there will be some winners and some losers. And we believe we are picking up winners based on their adoption of AI into their business model. They are more mid-cap oriented, smaller in size rather than larger in size. But will my call come right or wrong? Time will tell.
Great, thank you.
Nilesh bhai,
Siddharth, do we have time?
if I can just ask a final question on the currency side. Obviously, you've just spoken of, the FII erosion that we've seen. I think one of the contributing factors obviously has been the fact that, rupee has depreciated very sharply, especially in the last 3, 4 months. What is your view on currency? How do you see, where do we see the Indian currency probably vis-a-vis the dollar in the next 6 months? And can that act as a support system for the FI exodus? And you see some degree of stability there can sort of convince FIIs to invest back in India?
So, Siddharth, destiny of rupee is to depreciate. Our inflation is higher than our trade partners. Our productivity is lower than our trade partners. All of us enjoy buying gold, which we have to import. Put together, our current account and balance of payment remains under pressure. Rupee has to depreciate every year to remain competitive from export point of view. In the past, depreciation was 7%, then it became 5%, now it is 4%. But 3 to 4% depreciation of rupee is acceptable. That keeps Indian economy competitive vis-a-vis rest of the world. Now, most FPIs would have priced rupee depreciation into their portfolio calculation. They in turn expect higher rupee return because they know currency will take away 3 to 4%. And we'll have to live with it. I don't think so. Today we are in a position to make rupee appreciate through sharper productivity gains.
So
Right. So,
Nilesh bhai, anytime, just say that anytime I mean, when do we, what do we do? I mean, maybe you can give some your view on the earnings. But how and when do we see the FI flows finally kind of curbing out, because it's becoming too much of an excess from here. So yeah, continuing to what Siddharth asked you.
We need luck or divine intervention for FPIs to turn buyers. One, money should come out of America, and with dollar depreciation that normally happens. This time Trump साहब का डर इतना है कि कोई पैसा निकाल नहीं रहा. But collectively they would have lost $4-5 trillion as dollar depreciated. Second, that money, that flow should not go to China. If Chinese markets are outperforming Indian market, they are likely to do well. But if our markets outperform China as valuations have corrected, then those monies will come to India. So two lucky intervention, money coming out of America and not going to China.
And Nilesh bhai, how are you seeing the earnings coming out for quarter four? And while you had given projection of 27, 28, I mean, markets are ultimately, returns are slaves to the earnings. So how do you see with your lens on the earnings?
Even though only 30 days are impacted in the month of March 26, I believe earnings growth for fourth quarter FY26 will be almost zero. The hit taken collectively by the energy sector will probably wipe out all the incremental profit for the entire listed India universe. We expect earnings growth to decelerate to almost zero for fourth quarter because of this one-off cost. June 26 quarter will also see impact of crude oil prices. More importantly, we will see secondary and tertiary impact like fertilizer, sulfur, helium not being available. And if things normalize, Strait of Hormuz opens, flow of energy becomes fair, normal, regular, then we will see September 26 onwards earnings recovering, and maybe it will go to double-digit growth in second half of FY27 or CY26.
Great. Yeah, Siddharth.
yeah. So I'm a bit cognizant of time. I think we've run short of time. Thank you so much, Nilesh Bhai, and thank you to all the esteemed customers for joining us for this exclusive session on geopolitical developments and their impact on the Indian markets. Thank you so much. It'll be our endeavor to sort of bring such sessions to you at a certain frequency, and so please keep watching this space, and we'll get back to you. Thank you so much.
Thank you. Bye.
Thank you. Thank you.
Thank you. Bye.